Okay, good morning to all of you. Students, can you see the screen? Is it visible to everyone? Can anyone reply yes, sir?
Yes, sir.
Okay, perfect. So first, today we will see the market opening and the stocks which are performing good. Okay, first we'll see Nifty, that is NSE National Stock Exchange. So today markets are in green. Okay, so Nifty 50 is concerned, it is at 13,642.85. That is 75 points up. And you can see here the top gainers and top losers for the day. M&M, that is 739.3, that is last traded price. You can even see the volume over there. Tata Motors is concerned 182.95. So all these stocks are in green today. They're the top gainers. Then oil and natural gas company 102.65. Asian Paints, Tata Steel. Then some of the top losers for the day: Eicher Motors, Tech Mahindra, Gale, okay, 124.60. Then SBI Life and Dr. Reddy's. So this is about the NSE, and now we will just quickly see BSE. The market opening is concerned. So BSE Sensex sensitivity index, it is at 46,532.88. Today it is up by 269.71 points. So I think the market is opened in a very, very positive note. You can see some of the top gainers here: M&M, ONGC, Asian Paints. To my extreme right, you can see the cursor. So Tata Steel is concerned, it is up by 10 rupee 30 paise. Okay, so this is about the markets. And in yesterday's class, we were discussing about the portfolio, right? So what exactly we were discussing in yesterday's class? EMH, that is efficient market hypothesis. So quickly, we will just do a recap of the things, whatever we discussed yesterday, and then go ahead with the problems. So today, majorly, we will solve the problems, but before going to the problems, we'll do a quick revision of the concepts what we have discussed yesterday. See, we discussed about the behavioral finance, then random walk and efficient market hypothesis, then forms of market efficiency. Very important, we understood the portfolio management strategies. Can anyone tell me how many strategies are there? Majorly, we discussed about the active portfolio management strategy and the passive portfolio management strategy, right? Then we even came to know regarding active and passive portfolio management strategy. In active portfolio management strategy, we had a top-down approach. So all of you must be in a position to understand this top-down approach. As the name only suggests, here the portfolio managers, the fund managers observe the market as a whole and then decide about the industries and the sectors that are expected to perform well in the ongoing economic cycle. Whereas in case of bottom-up approach, what happens? The portfolio manager, he will see the market conditions and then expected trends are ignored and the valuations of the company are based on the strength of their product pipeline. So purely the fundamental analysis will be done here in case of bottom-up approach. That means the financial statements, the year-on-year revenue will be compared, the year-on-year profits will be seen, or any other criteria. It says the fact that strong companies perform well irrespective of the prevailing market or economic conditions. Then we understood the meaning of passive portfolio management strategy. So wherein here the manager or the fund manager, the portfolio manager relies on the fact that markets are efficient and it is not possible to beat the market returns regularly over time, and the best returns are obtained from the low cost investments kept for the long term. And the passive management approach of the or the portfolio management involves the following styles. So one, efficient market theory. Then we understood about indexing, then patient portfolio, aggressive portfolio, and conservative portfolio. Then today we will be solving the problems related to portfolio performance evaluation, wherein we'll be understanding the Sharpe's performance index, also called as SPI, the trainer's performance index, and the Jensen's performance index. Okay, students, before going to the problem, just I want a quick review from any one of you. Am I audible to you? Can you see the slide? Anyone can say yes, sir, so that I can proceed to the problems. Anybody? Am I audible to you? Or can you see the slide, students?
Yes, sir.
Yes,
Okay.
sir.
Yes, I want all of you to please have the calculators with you and your notes, because today we're going to solve the problems related to the portfolio performance evaluation. We're using Sharpes, trainers, and Genesis. And believe me, you might get a question, or two questions from this particular problems, and it is one of the easiest problem to solve. Okay, so first we will go for the problems. Okay, all of you, please concentrate. Now, what information they have given, let me just read it. The following information is provided regarding the performance of the mutual funds or the funds, namely the Birla Advantage, Sundaram Growth, and the Sun FNC for a period of 6 months, ending August 1999. The risk-free rate of interest is assumed to be 9. Students, I'm repeating, they have given me three funds, right? That is Birla Advantage, Sundaram Growth, and Sun FNC. And they have given me the RF value. Please understand, the risk-free rate of interest is what? RF. I'm repeating, RF value they have given, which is equal to 9. Then in the question, what they'll be doing is they'll be asking me to rank them with the help of Sharpe index and discuss. Okay, so the first thing what we'll be understanding, please concentrate, we are calculating this problem using Sharpe index. Okay, now you can see my cursor here. So they have given me a table wherein they have given me three funds, that is Birla Advantage, Sundaram Growth, and Sun FNC. Okay, now RP stands for what, students? Portfolio return. What they have given me is portfolio return, right? Then sigma p, they have given me sigma p. What is this? Standard deviation of the portfolio they have given me. Then what they have given me is beta, right? But what they have asked me in the question is, they have asked me to calculate or rank these three funds with the help of Sharpe index. Now please understand, students, this particular formula. Sharpe index, how do we calculate? It is very simple. RP, that is portfolio return, minus RF, that is risk-free rate of interest, divided by standard deviation. I am repeating once again, students. To calculate the Sharpe index value, we need to use this formula, that is RP minus RF, that is portfolio return minus risk-free rate of interest, divided by standard deviation. Okay. So first what I'll do is I'll take Birla Advantage fund. I take Birla Advantage fund. So what they have given me, 25.38 minus risk-free rate of interest. See how much they have given, 9, divided by standard deviation of Birla Advantage is how much? 4. Okay, all of you, I want all of you to solve. Use your calculator, students. That is 25.38 minus 9 divided by standard deviation is how much? 4, which is equal to 4.095, right? Then similarly, Sundaram Growth, that is 25.11 minus 9 divided by 9.01, which is equal to 1.788. Then Sun FNC, that is 25.01 RP value minus risk-free rate of interest is 9 divided by standard deviation of Sun FNC is 3.55, which is equal to 4.509. Now, the Birla Advantage fund ranks top among the three funds because you can see the conclusion over there at the end, because of the higher returns. How much? 25.38. And the low volatility. See the standard deviation over there? It is just 4. Okay. The Sundaram Growth Fund's return is high compared to Sun's, but the high volatility in return has made to be ranked third. You can see here. 25.11 is the Sundaram Growth return of the portfolio. But see the standard deviation here, students. It is 9.01. So yesterday we understood, right? If the standard deviation of the fund is high, we consider the fund to be risky. So we try to ignore it, right? But you can see here Birla Advantage. So in terms of returns, it stands number 1, that is 25.38. So I have ranked number 1 based on the Sharpe's index. We got 4.095. Okay. Then we went to Sun FNC value 25.01. Okay. But see the standard deviation value, that is 3.55, which is lesser than Sundaram growth as well as Birla Advantage. So I've called it, ranked it 2. And similarly, I went to the third one, that is Sundaram growth. Here the standard deviation of the Sundaram growth fund is 9.01, which is highest compared to Birla Advantage and Sun FNC. So I've ranked it 3. That's all. So how do we calculate the Sharpe's index? It is RP minus RF divided by standard deviation of the portfolio. Okay. So understood all of you? I'll take you to the next problem. Now the next problem goes like this, students. The following results were obtained. Okay, I want all of you to calculate for the same problem. I want all of you to calculate the trainer's performance index. Okay, please use your notes. Students, this is Sharpe's index, RP minus RF divided by standard deviation. So you have to calculate in the examination, if they ask you to calculate the trainer's performance index, how do we calculate TPI, trainers, TREYNORS, trainers performance index, TPI. So please use this formula, students, RP minus RF divided by beta. That's all. I'm repeating once again, for Sharpe's performance index, I use RP minus RF divided by standard deviation. Okay. For TPI, that is trainer's performance index, I use RP minus RF divided by beta. So all of you calculate for Birla Advantage, Sundaram Growth and Sun FNC, the trainer's performance index, and tell me the values. RP minus RF divided by beta is, for each fund you have to calculate the TPI value in the similar way. But only change is what? In case of Sharpe's, we are using standard deviation. But in calculating the trainer's performance index, we are using beta value. Okay. So anybody? I want all of you to solve the trainer's performance index for the 3 funds. There is a slight change in the formula. RP minus RF divided by beta. That's all. Okay. Anybody who has solved for Birla Advantage? What is the TPI value?
71.21, sir.
Very good. So you can rank it number 1 for Birla Advantage. I'm repeating all of you. Birla Advantage, the values you are getting is 71.21. Okay. Next, Sundaram Growth. Anybody has solved?
70.04, sir.
For what? For Sundaram?
Yes, sir.
You. Please
28.76, sir.
28.76.
Sir, 28.76.
Correct. Perfect. And then for Sun FNC?
27.13, sir.
Very good. Okay. So what we have solved now in this first problem, we solved the Sharpe's performance index. In the examination, they'll be directly giving you like this. Rank them with the help of Sharpe index and trainer's index, something like that. Okay. So Sharpe index, how do we calculate? RP minus RF divided by standard deviation. In the examination, they have to give all these values. RP, standard deviation and beta. So using this, we can easily calculate the Sharpe index and trainer's index. Now, can anyone tell me how we have solved the Sharpe index? Yes, Uma, how we have calculated the Sharpe index? Using what? Uma.
Hello, sir.
Yeah, Minaj, please speak.
Yes, sir. The formula for Sharpe index is, I think Uma is speaking, sir.
Yeah, please speak.
Formula for Sharpe index is RP minus RF divided by sigma. Standard deviation.
Hey, standard
RP.
deviation.
Yes, sir.
Correct.
Yes, sir. RP is return on portfolio.
Very good.
RF is a standard deviation of portfolio.
Hey,
Sorry, sir.
Minaj. RP minus RF divided by standard deviation.
Sir, what is that RF?
RF, what is that? Anybody? RF, in the problem they have given, see here, a risk-free rate of interest. RF is
Yes,
what?
sir, sir.
Please understand, risk-free rate of interest. Okay? Yes, continue, Minaj.
Okay,
RP
sir.
minus RF divided by standard deviation. And how do you calculate the trainer's performance index, TPI?
Trainer's performance index is equal to RP minus RF divided by beta value.
Very
They
good.
are given in the problem.
Perfect, perfect. Okay, that's more than enough. Okay. Now we'll go to the next problem. I request all of you to kindly mute your audio so that we can solve the next problem. Okay. Now problem number 2. The following results were obtained from a study for a period of 6 months in 1999. So the same funds they have given me, that is Birla Advantage, then PICICI Group, then Allianz Equity, then S&P CNX 500 and RF. Now students, please understand, they have given me RP. What is this RP? Portfolio return. They have given me standard deviation of the portfolio. Then they have given me beta value. Now please understand students, this S&P CNX 500, what you are seeing in the 4th row, this is market, that is index. Correct? S&P Standard & Poor's Index 500 is not fund, it's an index. And RF value also they have given, that is risk-free rate of interest they have given to be equal to 9. Okay. So what they have told me, using the inputs, rank the funds according to the predictive ability of the funds management. Please underline this. Predictive ability of the funds management. Okay. So they have not even asked me to calculate using Sharpe's or trainers, but what they have asked me, rank the funds according to the predictive ability of the fund management. Okay. I'm repeating once again what they have given. They have given me portfolio return. They have given me standard deviation of the portfolio. Then they have given me beta value of the 3 funds and index. This is index. And this is risk-free rate of interest. Okay. So now we will solve the problem, students. Now, so when I use the predictive ability of the funds management, the same word will be used. Okay. Predictive ability of the funds management. I use Jensen index, the 3rd type. First was Sharpe's, the second was trainers, and now I'm using Jensen index. Please understand this. Only 3 types are there. Okay. So the 3rd one is called Jensen. So how do I calculate? RP minus RF is equal to, this is the predictive ability, alpha P plus beta into RM minus RF. Now please see here students, the alpha P, the alpha of the portfolio indicates the managerial skills. To properly adjust the Jensen measure for ranking purpose, each asset's alpha should be divided by its beta. Very, very important. Now, first what I'll take is, I'll take Birla Advantage Fund. Now, what they have given me, Birla Advantage, the portfolio return they have given me, that is 25.38 minus RF value is 9. I don't know what is alpha P plus beta value they have given me 0.23 into our market return, RM. Now, please understand students, they have given me market return. I told you, right? S&P CNX 500 is what? Is the benchmark or the index. So they have given me this 36.74. I'm using directly here 36.74 minus RF, that is 9. So when I solve this, 25.38 minus 9 is 16.38, which is equal to alpha P plus, I get 6.38. So how do I get 6.38? It is 36.74 minus 9. Okay. So multiplied by what? Multiplied by 0.23. I get 6.38. Okay. Then what I do? Alpha P is equal to 16.38 minus 6.38, which is equal to 10. But what I do for ranking purpose here, to properly adjust the Jensen measure for ranking purpose, each asset's alpha should be divided by its beta. Correct? So alpha divided by beta. So alpha, I got the value to be equal to 10 divided by beta. See here, beta, that is for Birla Advantage Fund, it is 0.23. So 10 divided by 0.23 is equal to 43.48. Okay. So this is for Birla Advantage. What I'm solving now in the question, if they're asking me, rank the funds according to the predictive ability of the funds management. So I directly understand that I need to solve for Jensen index. So I use this RP minus RF is equal to alpha P plus beta into RM minus RF. So here in the problem, first I'll solve for alpha P. In this particular problem, alpha P is equal to 10. So to properly adjust the Jensen measure for ranking purpose, each asset's alpha should be divided by its beta. So what I do, alpha divided by beta, which is equal to 10 divided by 0.23, which is 43.48. Similarly, students, I will solve for PICICI group. Okay, that is what they have given me. 36.28 minus 9, which is equal to alpha plus 0.52 into 36.74 minus 9. Now you can ask me, sir, 36.74, they have given right here. It remains same for all the three funds because it is index or the benchmark. Okay, see here, this 36.74. So if I solve here, 36.74 minus 9, then 36.28 minus 9 is 27.28, which is equal to alpha P plus 36.74. 36.74 minus 9 is equal to 27.74 multiplied by 0.52. I get 14.42. So alpha P for PICICI group is how much? 12.86. But what I need to do now, alpha divided by beta. Each fund's alpha should be divided by its beta. So 12.86 divided by 0.52. How come 0.52 came? See here, PICICI group, its beta value 0.52. So I got 24.73. Now I want all of you in the same way to solve for Allianz equity. Note down all of you. I want all of you to tell me the value of alpha first and then solve. See, the question is here. You have understood now for how to solve for Birla Advantage and PICICI group. In the similar way, all of you solve for Allianz equity and tell me the value. You can note down for Allianz equity, the RP is 45.56, standard deviation is 4.31, beta is 0.63, and the benchmark or the index value, that is portfolio return, is 36.74. So you have to solve in the similar way. Please see here. If you want, take a quick pick of this particular question, and I want all of you to tell me the value for Allianz equity fund. In the similar way, you have to tell me Allianz equity fund. Here we have solved for Birla Advantage and PICICI group. How about Allianz equity fund in the similar way? Yes. Students, are you sleeping? Any data you want? You need to use this basically. Write down this RP minus RF is equal to alpha P plus beta into RM minus IRF. Write down in your notes and put this value of Allianz equity there. Any one of you can tell me so that I'll be happy.
So alpha P is 19.
Okay.
And alpha divided by beta is 30.29.
Oh my God, fantastic. Others, anybody who has got the value for Allianz Equity Fund? Okay. What's your name, ma?
So Vaishnavi.
Okay. Very good, ma. Okay. Check all of you for Allianz Equity. See, 45.56 minus 9 is equal to alpha p plus 0.63 multiplied by 36.74 minus 9. So first what we'll do, 36.74 minus 9 multiplied by 0.63. I get this value, 17.48. So 36.56 minus 17.48, which is equal to 19.08. Then what I should do here, I divide alpha divided by beta. So 19.08 divided by 0.63, which is equal to 30.29. Got it, students? So in this problem, what we have done, first we have calculated the value of alpha. Then afterwards, we have divided each alpha divided by its beta. So based on that, we have ranked it. Next problem. Now, the following three, are you with me, students? Am I audible? Can you see the screen?
Yes, sir.
Okay. The following three portfolios provide the particulars given below. So how many columns are there? 4 columns are there. In the first column, what they have given? Portfolio A, B, and C. So they have given me average annual return, that is 18, 14, 15, and 13. So don't get confused over there. This is the market and these are the funds ABC. Okay. So they have given me 3 funds and 1 market and average annual return. Then they have given me standard deviation of all, that is 27, 18, 8, and 12. Then they have given me correlation coefficient 0.8, 0.6, 0.9. Now, the risk-free rate of interest is also given. How much? 9. Now, what we have to do is, we have to rank these portfolios using Sharpe's and Trainer's methods. Okay. And then compare both the indices. Now, all of you know how to calculate the Sharpe's, right? So, I request all of you to calculate Sharpe's individually. First, you take fund A and then you do RP minus RF divided by standard deviation for each. Similarly, fund B, RP minus RF divided by standard deviation. Similarly, C, RP minus RF divided by standard deviation. So calculate and tell me the values for A, B, C. Don't calculate for market. Only we have to rank the 3 funds, that is A, B, and C. See, first you calculate the Sharpe's and tell me the values. Then we will go for calculation of trainers. Okay. See, this problem, in the earlier question papers also, the same problem was asked. So please concentrate. This is very simple problem to get the marks. Okay. First, I request all of you to calculate the Sharpe's using the formula RP minus RF divided by standard deviation. So first you have to write A. RP is what? 18 minus RF is what? 9 divided by standard deviation is what? 27. So like that, I want all of you to calculate for A, B, and C and tell me the values.
Sir, for A, 0.33. So,
Yes, anybody?
sir, good morning, sir.
Yeah, tell me.
0.363, sir.
You have to tell for fund A, you are telling?
Fund A, sir.
How you have calculated, please tell me.
Sir, RP minus RF divided by standard deviation.
Okay, tell me the values. 18 minus 9 divided by See the screen over there.
Sir, 27.
Very good. So how much you got?
0.33, sir.
Very, very good. And B for fund B?
Sir, 0.27.
0.277. And
Sir.
for C?
0.75, sir.
Very good. So which is highest here? Rank the three funds. First comes C, then comes A, and then comes B.
Then B, sir.
Okay. So 0.75
Yes,
comes first. Okay, all of you can see the solution here. Very good. Very good. What's your name?
Sir, Bharat, sir.
Bharat. Okay. See, all of you, it's very simple. RP minus RF divided by standard deviation. I got 0.3333. It's recurring. And similarly for B, that is fund B, we got 14 minus 9 divided by 18. We got 0.277. And similarly for fund C, we got 15 minus 9 divided by 8. That is equal to 0.75. Then we have ranked these three funds. This is very important problem, students. The same problem has repeatedly come in many papers. I'm repeating to all of you. Okay. So if you rank, this comes C, 0.75 comes first, then A comes second, and B comes third. Now, Bharat, seeing the problem for trainer's performance index, one parameter is missing, right? So what is that? In order to calculate trainer,
beta value.
Beta value is missing. But instead of beta value, what they have given me? Correlation coefficient. So why this problem is important? Because beta value is missing in this problem. So you need to calculate beta value. Clear, students? Please understand. So instead of beta, what they have given me? Correlation coefficient of A, B, and C. That is 0.8, 0.6, and 0.9. So Bharat, how do we calculate the trainer's performance index? Please tell me the formula.
Sir, RP minus RF divided by beta.
Beta.
Sir.
Fantastic. Now, since they have not given me the beta value, see all of you, trainer's index, RP minus RF divided by beta. Now, in this problem, since the beta values are not given, beta values can be estimated by using the formula. Beta is equal to correlation coefficient R multiplied by standard deviation of the portfolio divided by standard deviation of the market. I am repeating once again, students, since they have not given me the beta value in this problem, so in order to compute the trainer's performance index, we require beta value. But instead of beta value, what they have given me? The correlation coefficient value of each fund they have given me. So what is the formula I'm going to use here to first calculate beta of each fund? Beta is equal to correlation coefficient R multiplied by standard deviation of the portfolio divided by standard deviation of the market. So for each individual fund, I need to calculate first beta value. So similarly, I'll take A. So what is the correlation coefficient value they have given me? See here, all of you, 0.8. Okay. 0.8 multiplied by, what is the standard deviation of the portfolio they have given me? See here, standard deviation is 27. Clear? Divided by, what is the standard deviation of the market they have given? All of you see here, standard deviation of the market is 12. Clear? So I get the value to be equal to how much? 1.8. What is this 1.8? It is beta of A, fund A. Clear, all of you? Then similarly, beta of fund B is, how do we calculate? 0.6 multiplied by 18 divided by 12, which is equal to 0.9. And similarly, beta of C is equal to how much? 0.9 multiplied by 8 divided by 12, which is equal to 0.6. Now, once we have calculated the values of beta, students, so I use the formula, that is trainer's performance index. So trainer's performance index for fund A is how much? 18 minus 9 divided by beta value, what we have calculated is 1.8, which is equal to 5. Then similarly, the trainer's performance index for the fund B is how much? 14 minus 9 divided by 0.9, which is equal to 5.56. Similarly, for the trainer's value for the fund C is how much? 15 minus 9 divided by 0.6, which is equal to 10. Now, if I rank from highest to lowest, students, in case of trainer's performance index, how can we rank? First comes 10, correct? See here, 10. And then comes fund B, that is 5.56. And next comes fund A, that is equal to 5. So the order or the ranking order is how? C, B, and A. Okay. So the order of B and A get reversed in the trainers index. This may be due to their relationship with the market, that is systematic risk factor. Right, students? So in this particular problem, which is also a very important problem because they have asked in almost many papers wherein they have not given me the beta value of the funds, but we need to calculate the beta values of the fund using this particular formula first. Don't get confused. So beta is equal to correlation coefficient multiplied by standard deviation of the portfolio divided by standard deviation of the market. Then when once you calculate the beta values of A, B and C, then what we have to do is we have to apply to the formula to calculate the trainer's performance index, which is equal to RP minus RF divided by beta. So we get the values of fund A, fund B and fund C. Wherein when we are solving the sharpest performance index, what we do? We calculate RP minus RF divided by standard deviation. See this RF value, someone was asking me, sir, how to identify? They'll be giving me in the problem, that is the risk-free rate of interest to be equal to 9. So that is it. That itself is RF value. Okay, RF value. And one more problem what we solved was related to the Jensen's. That is RP minus RF is equal to alpha P plus beta into RM minus RF. Here, how do we rank? We have to divide each fund's alpha should be divided by its beta. Then only we can rank the fund. Clear, students? So these are the major 3 types of problems which are there in Unit 6. That is sharpest performance index, RP minus RF divided by standard deviation. Then trainer's performance index, RP minus RF divided by beta. So if they have not given me the value of beta, we can calculate the value of beta if they give me correlation coefficient. That is beta of the fund is equal to, how do we calculate? Correlation coefficient multiplied by standard deviation of the portfolio divided by standard deviation of the market. Understand, students? Okay. Next, Jensen's performance index. We have to use each alpha divided by its beta to calculate the Jensen's performance index. So any doubt till here, please ask me. Students, any doubts till here? Can anyone do a summary, quick summary, what all things we have discussed today, so that I'll be happy? Yeah, anybody? First you start from Sharpes, trainers and Jensen, and we'll stop today. Yeah, anybody? Even if it is wrong, I'll help you, don't worry, but please speak. Yes, Minaj, Shruti. Prashant, can you just tell me first, sharpest performance index, how we have calculated that? Yeah, Vaishnavi?
Yes, sir.
Yeah, first tell me how we have calculated sharpest.
Yes, so formula for Sharpe is RP minus RF divided by standard deviation.
Very good.
And for trainers, performance of index is RP minus RF divided by beta.
Beautiful.
And then Jensen index, formula for Jensen index is RP minus RF is equal to alpha plus beta multiplied by RM minus RF.
Very good. And how do we rank using Jensen's?
So each alpha is divided by beta.
Very good. Very good. Okay. Thank you, Ma Vaishnavi. Now let me ask you some of the things. Okay, in the problem, Balabai Nayak, good morning. Am I audible to you? Balabai Nayak, good morning.
Yes, sir. Good morning, sir.
Okay, what is RM?
Market returns, sir.
Fantastic. Kindly mute your audio. Okay, Deepika, good morning.
Good morning, sir.
So when I say alpha P, what is that?
Alpha, sir, portfolio of alpha, sir.
Sorry. Standard deviation of the portfolio, right? Sigma P.
Sigma P.
What is sigma P?
Portfolio of variance, sir.
Standard deviation of the portfolio, right?
Okay, sir. Sorry, sir.
Okay, what is RF, Deepika?
Return of RF, sir. Return risk-free rate of interest, sir.
Very good, ma. Okay, I hope all of you understood today's problem. So we majorly solved Sharpe's, Trainers, and Jensen. Right? Any doubts, you can call me. And from the next class onwards, I'll start the revision and question paper solving. Okay? So thank you so much, students. I hope all of you understood today's session. I'll end the session today.
Thank you, sir.